key things to look out for this evening really are going to be what monetary policy looks like going forwards. Okay, 70% of the markets were right. I put my name against the basis point cut as well. I was not in the 30% of commercial liquidity that thought their rates were going to remain stable. Good evening, ladies and gentlemen, and welcome one and all to this evening's Fed event live with the UTC. Good evening to you guys inside the trading room. Great to have you here. I'm a bit surprised, to be honest. Great to see you, though. Thanks for joining me at this ungodly hour of 7 as we approach the Fed press conference. And good afternoon to everybody on YouTube as well. Good to see all of you out there, all of you hungry traders ready for some Fed action. Do forgive me for stumbling and spluttering and going off on wild tangents this evening as we get the show underway. It's a very unusual time for me where usually I'm being beaten up by the kids. But you've managed to save me from that. So, hope you're all well, as I've already mentioned. Good to see you, Scotty D, as well. I don't know if you're back now from sunning it up on the beach, but hope you had a great time if you are back, and welcome to a rainy, cold England. Otherwise, in big market news, we did have the 25 basis point cut from the Fed. I have not taken any kind of trades whatsoever from the initial Fed event. I wanted to see what happened, let the dust settle. Also, to be honest, trader excuse incoming. The spreads, I don't know what the hell was going on for me in particular. The spreads are usually pretty decent, but the spreads were absolutely insane. So yeah, it was just too costly even looking to trade the markets at the actual time of the release. Obviously, there is a shed load of liquidity flying through the markets at the moment, and I am not at the top of the pecking order as much as I wish I was. But there we go. So it's pretty choppy out there. We did have a pretty explosive breakout. The DXY dollar index at the moment, it can be seen trading lower, but it is coming back just slightly as we look down here. It's currently trading in 96.33, but if we go down the 15-minute time frame, we had one whopping 15-minute candlestick here. Really quite an extended move straight down to 96.20, and now it's come back up as the markets are sort of settling themselves in anticipation of watching Chair Powell carry out the press conference, which is what we're kind of ultimately it's what we're here for. So what we're going to be doing this afternoon then, we're going to be looking at the press conference. I'm going to be providing real-time analysis over the press conference whenever necessary, whenever possible. I will be watching this in real time with you guys. So there's going to be, there'll probably be extended periods of silence from myself as we let Powell speak and answer questions, and then if there's anything that I'd like to step in on and explain in further detail, then I will do so. Also, please feel free to ask questions throughout the session. I may not get back to you immediately, but I will get back to the questions no matter what. But yeah, let's just kick back. I've got a nice drink here, so I'm going to kick back, have a drink, and yeah, we'll chew the fat over the FOMC Fed event this evening and see what's going on. The key things to look out for this evening really are going to be what monetary policy looks like going forwards. Okay, 70% of the markets were right. I put my name against the basis point cut as well. I was not in the 30% of commercial liquidity that thought their rates were going to remain stable. So that part is now done and dusted. We have been anticipating a September 25 basis point cut for a long time. What does monetary policy look like moving forwards? I'm thinking Q1 to Q3 2026. That's what I'm focusing on at the moment. So sort of the next 4 quarters in that yearly, so that sort of annual cycle. Okay, fair enough. I'm not looking ahead to December, Q3 kind of time, this time next year, for example, but really interested in what Q1 through Q3 look like. The questions that will be asked will be similar to what I want to know. I have no doubt. What does the forward policy look like in terms of where they are positioning themselves right now and where the data is sort of trending? But I should imagine that Powell is going to keep the cards close to his chest. He is a central banker. They are very much politicians, even though they're not. They are very much politicians and tacticians at that, and very, very good at being able to dodge the question with, we will react in accordance to the trends in the data. But, and there is a but, sometimes they do have a very good roadmap and they will hand out cookies if you're nice, if you're lucky. Sometimes you'll get a cookie and you will, sometimes get, okay, this is where we were, the data is coming down, the inflation numbers, they are being, they are reducing at a rate now that is kind of in line with what we would have expected. So we're probably going to look at another 25 basis point to come in the next cut. Q1 25 basis points, Q2 no rate cut, Q3 another 25 basis points, back to the 2% inflationary target, foot off the gas for monetary policy, and then we see low interest rates again. We start to see the next sort of bull cycle start to take place. There's a lot of moving parts here, though. What's the time? 22 minutes past 7. Okay, we've got 8 minutes to go. There's a lot of moving parts here because the stocks in particular have been pretty nuts in terms of their cycle, their growth cycle so far in 2025. We're still looking at relatively high rates across the US, and the US stock markets have actually rallied the crap out of it regardless, which is not very historic if we look at historic trends in the data. That's quite of a separation from the historic data. So it will be interesting to see really what happens if we start to see an exponential growth cycle in 2026 as a result of the monetary policy. And so these are the kinds of things that I'm personally looking at, because obviously I'm always trying to think about how I'm going to make money, right? How am I going to, where's the next big thing coming from in the markets that I can build into the portfolio? Where's that sort of next major return going to come from? The stocks have been incredible, but they haven't always made sense. And I'm just thinking to myself here, the S&P is trading at 66.10. The high last year was, I don't know what it was, but I mean, we're seeing significant growth cycles at the moment. Is that going to continue in 2026, or are we going to look at another crash out? Are we going to look at something like, like this, for example, where we wipe out a load of gains for some reason? So anyway, this evening, it's just about to kick off anyway. We've got 6 minutes to go. In terms of trading opportunities this evening, I am going to be it's going to be very off the cuff, as it has to be. Sometimes, I will do my best to plan ahead. And so we get a load of pending orders in the market. That's how I would usually carry out my CPI trading sessions, for example. I would have a series of pending orders in the market. Actually, tonight is not going to be anything like that. It's going to be very off the cuff. I'm going to be taking market orders, 0.25% risk per position. Sorry, I beg your pardon, 0.2% 5% risk per position on everything tonight. And that's, yeah, and I'm just going to be running with the ebbs and flows of the market. So it's going to be very quick fire. If you are following along, then please do be prepared. So for those, I would say for those of you who have been following for a good while, you're an in-house UTC trader. I'm not going to teach you how to suck eggs. At the end of the day, you are the masters of your accounts. You understand how we work here. You understand how the fund works, how the system works. So, you know, that's fine. If you are on the outside, for example, I don't know, you know, guys on socials or whatever, or in the general chat, then of course, just be extremely careful. I probably would urge you against following along if you're either inexperienced, which is absolutely fine. Get out a paper trading account and just follow the ebbs and flows of the market with us, and you know, see what it's like and get a feel for it. Excuse me. Right. So we have got 3 minutes to go. 3 minutes 30 seconds. Primary trading assets this afternoon. So for one thing, this, if we go down to the 1 minute time frame here, I was looking at this, is it was actually quite beautiful. We had the big spike up and then it went straight down to what would have been the stop loss. But I have confirmed that is in the account. So that is the gold long that we took at the beginning of the day, which was our long from the weekly analysis market report that was launched this week on Monday. Absolutely fantastic trading opportunity. A 1 to 3, that's, you know, 0.78, I think it was. I think it was the net figure in the MT5. So really, really pleased with that one. So that's as a result now of the Fed event. So I'm gonna personally label that one onto the Fed so we can go and so I can account for the losses that I will probably take on board over the course of the next half an hour or so. Right. We've got, what have we got? We've got a couple of minutes to go now. I've got the session ready to rock and roll over here. Let's just make sure that that's all okay. Yeah, let's just make sure that's all okay. I guess we're only going to know if it's okay at the point in time. You can watch it on YouTube as well, but I'm on the Border.gov website. It's sometimes a little bit better watching the direct feed from the governor's page rather than the YouTube feed whilst I'm streaming, that is. And yeah, we'll get going. There is one annoying thing. Discord, I can't stream 2 screens at once. So it will be on the catch up session, of course. But for you guys inside the trading room, just keep an eye on the chat, because if there are any quick fire trades I'm considering, I will, of course, ping you the opportunities inside the feed. So just be aware of that as well. You got back home a few hours ago, just catching up on the message, Scotty D. Good man. Very good. That's dedication right there, man. Very good. I hope you had a lovely time away. The pictures looked, the picture looked amazing. Okay. What's the time? We've got 1 minute to go. I'll refresh the page on here, see. Okay, yeah. Here we go. Right. It was excellent, mate. We'll catch up properly tomorrow. Yeah, sounds good, buddy. Yeah, look forward to it. All right, let's have a look then.
The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of this slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter.
Here to the session.
Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.7% over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate,
very important
based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans.
There's a lot of
We
market
understand
risk
that our
there
actions
with
affect
the
communities, families, and businesses across the country.
stagnated reduction in
Everything
rates
we do
for
is
the
in service
US.
to our public mission, and we at
Markets
the
won't
Fed will
like
do
that,
everything we
especially in
can
stocks.
to achieve our
Still
maximum
thinking
employment
we're
and
good on the
price
short
stability
so far.
goals. Thank you. I look forward to our discussion.
All right, time for some interrogations.
Great. Thank you, seated press. As you know, Fed Governor Stephen Myron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
Shots fired about the Trump situation.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation, although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation? Thank you.
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation. And actually, the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point, and we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers. And at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. You know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
I'll make a secondary plan.
Nick Timmerosa, the Wall Street Journal. Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years, and you tend to do those at a time when we feel that policy is a place and needs to move quickly to a place. That's not at all.
Got a bit of buffering here going on at the moment. Just bear with. Okay, we're in on the second Dow short. Oh, man. Not good on the buffering side of things, though. I use the direct gov feed because YouTube usually does this.
I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP,
Oh, no way. Come on. Right. Give me a sec. I'm going to try and go to the YouTube feed instead.
inflation on a sustained basis, and we will do that. At the same time, we've got to weigh the risks to the two goals. And I would say since April, to me, the risks of higher and more persistent inflation have probably become a little less. And that's partly because the labor market has softened, GDP growth has slowed. So I would just say that the risks there have been less than one might think. And in terms of the labor market, what we're seeing is unemployment is still low. It's still a relatively low rate, but we're seeing downside risks.
Michael McKee from Bloomberg Radio and Television. I'm a little confused by
Second
your
Dow
explanation
Jones has
of
hit
the
VP.
Fed cutting rates because
That's
of
another
unemployment. If you
0.55
think that most
net
of what's
return.
happening in
We're
the
up over 1%
employment
now
area
from the
is
Fed
related to
event this evening, which is
immigration,
great
which your
news.
rate cuts wouldn't address.
Gonna take my foot off
How
the
do you
gas here,
see
shorting it
that
down.
as more
Might look at
important
possible
than
recovery in US
inflation, which
tech
has
stock coming
remained
into play. We're down
almost a full percentage point above your target?
0.86% on
Well,
daily
I was
change so
I was
far
saying
from
that
the
what's
AP
happening in the
buyback
labor
unit
market has
coming into
more
play
to
here.
do with immigration than it has to do with tariffs. That was the question I was answering. So I wouldn't say that all of what's happening in the labor market is due to tariffs. I mean, you clearly have a slowing in it due to immigration. You clearly have a slowing in demand, which is now perhaps more than that in supply, and we know that because the unemployment rate has ticked up. So, that's what I meant by that.
I can follow up. Every year since 2015, the SEP has forecast that you would hit your target 2 years later. And this year, this SEP says you're going to hit your target 2 years later. 2% does not seem to be in sight. Does that suggest that the 2% target is not really achievable? And does this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years, but the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though, right? We have to. Our job is literally to make sure that is what happens, and we will do that job. Right now, the situation we're in is that we see inflation. We continue to expect it to move up, maybe not as high as we would have expected it to move up a few months ago. The pass-through of the tariffs into inflation has been slower and smaller. The labor market has softened. So the case for there being a persistent inflation outbreak is less. And so that's why we think it's time for us really to acknowledge that the risks to the other mandate have grown and that we should move in the direction of neutral. So what will we do? We'll do what we need to do, but we have two mandates and we try to balance them. For a long time, our framework says that when our two goals are in tension, this is quite an unusual situation. How do we decide what to do? Because our tools can't do two things at once. What we do is we ask which is farther from, how far is each from the goal and how long is it expected to get to the goal? So, and then we think about those things and we see, as I mentioned, we have been our policy had been really
I have to
skewed
say,
toward
Powell's
inflation
looking a
for a
bit
long
tired.
time, really. Now we see that,
the latest White
there's
House
downside risk
administration
clearly in the
probably
labor
done him
market,
in
and so we're
a bit.
moving in the direction of more neutral policy.
Concerned are you about the
We've
slowdown in the
spoken a
jobs
great deal
market
about the
for
tariff
households at home,
situation, haven't
especially
we?
younger Americans
over the
struggling
course of the last
to land
6
a job?
months, what that looks like
So
down
it's
the line.
an interesting labor market, and
Certainly looks like it's
obviously
stressing the Fed out. That's for sure.
we think it's appropriate that we reduce our rates so that we become more neutral, which presumably will be better for the labor market.
I've just taken along
You see people who are sort of
NAS
more at the
100
margins,
guys on
so
buyback.
kids coming out of college and younger people, minorities are having a hard time finding jobs. The overall job finding rate is very, very low. However, the layoff rate is also very low. So you've got a low firing, low hiring environment, and the concern is that if you start to see layoffs, the people who are laid off there won't be a lot of hiring going on. So that could very quickly flow into higher unemployment. In a healthier economy, healthier labor market, there would be jobs for those people. But now the hiring rate is very, very low. So that's been a growing concern over the last few months. And it's one of the reasons why we think it's appropriate that we begin to shift our policy focus toward a more balanced one.
Steve Leisman, CNBC. Mr. Chair, in the past, during rate cuts, you used the word recalibration. And I wonder if you pointedly did not use it this time. And in fact, when you said policy is not on a preset course, did you mean that as sort of the opposite of recalibration? Are we meeting to meeting, data point by data point? Are we in the process here of getting back to neutral? Thank you.
So I think we're in a meeting by meeting situation. We're going to be looking at the data. Let me say a word about the SEP really here. So we often point this out. What the SEP is, it's an accumulation of the individual projections of 19 people, showing what they believe at a particular moment in time to be the most likely path for the economy and thus the appropriate path for monetary policy as well. And as you know, we don't debate or try to agree on what that is. We just write them down and accumulate them. We do sometimes discuss them. And so we always say we're not on a preset path, and we really mean that. The actual decisions we make are going to be based on the incoming data, the evolving outlook, and the balance of risks at the time the decisions are actually made. So you will have seen that we have 10 participants out of 19 who wrote down 2 or more cuts for the remainder of the year, and 9 who wrote down fewer than, in fact, in a good number of cases, no more cuts. So rather than looking at this as certainty, I would encourage people, as always, to look at the SEP as through the lens of probability. And so there are different possible outcomes and likelihoods rather than this one is certain and this one isn't happening. So that's what I would say.
Thank you for getting to my follow-up question, which was, is the dispersion in the outlook a sign of uncertainty of policy in the meetings to come? Thank you.
It is such an unusual situation. Ordinarily, when the labor market is weak, inflation is low. And when the labor market is really strong, that's when you got to be careful about inflation. So we have a situation where we have two-sided risk. And that means there's no risk-free path. And so it's quite a difficult situation for policymakers. And it's not at all surprising to me that you have a range of views. It's not so much about having different views for the path of the economy, but it's partly that. But it's also partly about what's the right thing to do in light of the tension between the two goals. How do you weight them? How worried are you about one versus the other? And so it's natural. I think it would actually be surprising if you didn't have a pretty wide range of views based, in this kind of highly unusual situation, and we do. So, but we get together, we discuss, we have a great discussion, and then we decide what to do and we act. But you're right that it's a wide dispersion of views, and I think that's understandable and natural in the current situation.
Hi, Victoria Guida with Politico. You've talked a lot about Fed independence and the importance of it over the years. But as markets have questions about what exactly President Trump's intentions are with the Fed, what would you point to as the things they should be watching to determine that the Fed is still making decisions based on, the economic outlook rather than political considerations?
Look, it's deeply in our culture to do our work based on the incoming data and never consider anything else. That's just everybody who's at the Fed really feels strongly about that way. So, you'll know it by the way we talk about what we're doing, by the speeches that people give, by the decisions that we make. You'll know that we're just still going to do that. That's all we do. And we don't frame these questions at all or see them in terms of political outcomes. I think when you get to another part of Washington, everything is seen through the lens of, does it help or hurt this political party, this politician? That's the framework. And I think people find it hard to believe that that is not at all the way we think about things at the Fed. We're taking a longer perspective. We're trying to, serve the American people as best we can. So I think you would be able to tell. I don't believe we'll ever get to that
unimportant
place.
question, to be honest.
I would say we're doing our work exactly as we always have now, and people they're making their arguments, and we're having a great discussion around these challenging issues. So,
You see the court case around Lisa Cook as being related to questions of Fed independence?
I see it as a court case that it would be inappropriate for me to comment on.
Thanks, Mr. Chairman. Edward Lawrence from Fox Business. So we saw the preliminary benchmark revisions down 911,000. The revisions for June were the first negative revisions we've seen since December of 2020. How can the Fed base important decisions on rate and what to do with the interest rates on data that seems to be, as you've called it in the past, noisy?
So on the QCEW, the revision that we saw was almost exactly what we expected. It was amazing how close the expectation was. So, and the reason for that is, for the last bunch of quarters, there's been almost a predictable overcount. And I think the Bureau of Labor Statistics really does understand this, and they're working hard to fix it. It's got to do, of course, it has something to do with low response rates, but it's also got to do with what's called the birth-death model, because a good amount of job creation happens around new companies and how many go out of business, how many are founded. And it's just really hard. You can't survey for that. You've got to have a model that predicts that. And it's quite difficult to do, especially when the economy is undergoing big changes.
On the line. I'm not taking the trade
they've
yet,
been working on that and are making progress on it. But the data we get is still good enough for us to do our work. To the extent we have issues around data right now, it's about low response rates. That's happened all over, really. Response rates are just lower to surveys now, both in and out of the government.
If it's a loser,
and it's no great secret. We want higher response rates, and we need those to have, less volatile data. And the way to get that is to make sure that the agencies that collect the data have sufficient resources to drive higher response rates. It's not a complicated problem, but that's what it takes. It's not a mystery. That's what it takes. The other thing I'll say, Edward, is in the case of the job creation, the response rate is quite low for the first month, or lower for the first month. By the time you get to the second or third month, you're still collecting responses for that last month, for that prior month. And you get to the place where the data are much more reliable by the second and certainly the third month. So it's not that we don't get the data, it's just that we get it a little later.
For the benchmarks, if that holds, it's 51% of the jobs that we thought were there weren't really there. It shows a weaker job market coming into this year. If you had that information, would it have changed your mind related to where the interest rates should be? Should there have been a cut earlier?
We have to live life looking through the windshield rather than the rearview mirror, as you know. And all I can tell you is we see where we are now, and we take appropriate action, and we took that appropriate action today.
Thanks. Howard Schneider with Reuters. So as you mentioned a minute ago, some margins of the job market would suggest that the slide's already happening. A black unemployment rate in August was above 7%, declining work week, difficulty among college graduates finding work, rising youth unemployment. Why do you think a quarter percentage point now is going to arrest that?
Well, I didn't say that I thought a quarter point would make a huge difference to the economy, but you've got to look at the whole path of rates, right? And the market's has already been baking in expectations. I mean, our market works through expectations, right? So I think our policy path really does matter. And I think it's important that we use our tools to support the labor
That might
market
be
when we
bad
do
news for
see
the NAS trade.
signs like that. I did mention that. You see minorities, unemployment going up. You see younger
coming down a
people
bit.
who are more vulnerable economically, more susceptible
Far
to
from over
economic
yet.
cycles. That's one of the reasons, in addition to just overall
Didn't like the way he
lower
answered that, though.
payroll job creation, that shows you that at the margin, the labor market is weakening. I would also point to labor force participation. Some part of the significant decline in labor force participation over the last year has probably been cyclical in nature rather than just the usual aging process. So we put all those together, and we see that the labor market is softening, and we don't need it to soften anymore, don't want it to. So we use our tools, and it starts with a 25 basis point rate cut, but the market's also pricing in a rate path. I'm not blessing what the market's doing at all. I'm just saying it's not just one action.
As a follow-up to that, the growth mix right now seems very concentrated in investment and on the consumer spending side in the higher income groups. Do you feel that that's an unsustainable
I can barely hear
mix
this bloke talk.
for the economy moving forward?
I wouldn't say that. I mean, you're right. Those are two. We're getting unusually large amounts of economic activity through the AI build out and corporate investment. I don't know how long that will go on. No one does. In terms of spending, you saw that the consumer spending numbers were well above expectations, and that may well be skewed toward higher earning consumers. There's a lot of anecdotal evidence to suggest that. Nonetheless, it's spending. So, I mean, I think the economy is moving along. Economic growth is going to be 1.5% or better this year, maybe a little better. Forecasts have been coming up, as you can see. So, labor market unemployment is low, but downside risks, but it's still a low unemployment rate. So, that's how we see it.
Hi, Stephanie Rule, MSNBC. Treasury Secretary Scott Bessent has said that the Federal Reserve suffers from mission creep and institutional bloat. He's now calling for an independent review. Would you support an independent review, or are you open to any sort of reform in any areas of the Fed?
I, of course, am not going to comment on anything the Secretary says or really any other officer says. So in terms of reform at the Fed, we just went through a lengthy and I think very successful process of updating our monetary policy framework. I would say there's a lot of work going on behind the scenes around the assets we have in the Federal Reserve Bank system, Federal Reserve system, and at the board. Are they the right size? We're actually going through a 10% at 10%
just take
head
profit
count
on
reduction
a 1 to 2.8 in the NAS 100
through the whole
guys.
Fed, including the board and all the reserve banks.
3 wins,
The
1 loss so
employment
far.
at the Fed at the end of that will be
Beauty.
basically at the same level it was more than 10 years ago. So we will have had zero job growth for more than a decade when we're finished with that, and I think we'll probably do more than that. So I think we're certainly open to constructive criticism and ways to do our jobs better.
But not an independent review?
We're certainly open to always trying to do better.
Mr. Chairman, Neil Irwin with Axios. There's been some debate lately on whether AI is already starting to affect the labor market in terms of lower labor demand, higher productivity by contrast. Do you buy that? And if that is true, does that have implications for the monetary policy setting?
So there's great uncertainty around that. I think my view, which is also a bit of a guess, but widely shared, I think, is that you are seeing some effects, but it's not the main thing driving it. And so particular focus on young people coming out of college. And yeah, there may be something there. It may be that companies or other institutions that have been hiring younger people right out of college are able to use AI more than they had in the past. That may be part of the story. It's also part of the story, though, that job creation more broadly has slowed down. The economy has slowed down, and so it's probably a number of things. But yeah, it's probably a factor. Hard to say how big it is.
Thanks, Mr. Chairman. What evidence do you see of tariffs showing up in inflation?
Well, if you can take goods, just sort of the broad goods category, and last year, goods inflation was negative. if you go back 25 years, that was the typical thing, was that goods inflation was, goods prices generally went down, even adjusting for quality. So that was not the case during the pandemic, of course. Goods inflation went very high, but we had essentially returned to zero or slightly negative inflation. Now, I think goods inflation over the course of the past year is 1.2%, which doesn't sound like a lot, but it's a big change. So we think, I mean, analysts have different views, but we think it's contributing, 0.3 or 0.4, something like that, to the current core PCE inflation reading, which is 2.9%. So it's contributing. What seems to be happening is that, the tariffs are mostly not being paid by exporters, mostly being paid by really the companies that sit between the exporter and the consumer. So if you buy something and you sell it through retail, or you use it to make a product, you're probably taking a lot of those costs on and not able to pass it fully along to the consumer yet. That appears to be what we're seeing. All of those companies and entities in the middle, they'll tell you that they have every intention of passing that through in time, but they're not doing that now. To the consumer, the pass-through has been pretty small. It's been slower and smaller than we thought. But the evidence is, it's very clear that there's some pass-through.
What's going on here? So,
I also wanted to ask if you could share with us the conditions under which you might consider leaving the Fed in May.
I have nothing new on that for you today.
Interesting. God, that was shot down, wasn't it?
Hi, Katerina Saraiva with Bloomberg News. I just wanted to follow up on one of your answers just a couple minutes ago. We've often heard you talk about how you and your colleagues, do not think about politics. This does not enter the room. But one of your new colleagues does come from this world, right, where everything is seen through this framework of politics and of what party is being helped, and that person is still employed by the White House. How can markets and the public interpret, some of his speeches, for example, and then the forecast that we see today? I mean, the median for this year was moved because of the introduction of his forecast.
We're
I'm
starting
talking
to
about
get
the number
we're
of
starting to get the
rate
watered
cuts seen
down
this year.
stuff now. They usually leave
What
the
do you what do you say to
the least
markets and the public
important
that are trying
reporters
to
for last
interpret
and get all the good
what
stuff
you've
out
early?
I
So there's 12,
don't know about you
12
guys,
vote, 19
but
participants,
I've heard,
of
I
whom
think,
12
everything I
vote,
want
as
to
you know, on
hear,
a rotating basis. So no one voter,
from the session so far.
can really,
What
the
how are
only
you
way
guys
for any
feeling
voter
about
to
it?
really move things around is to be incredibly persuasive. And the only way to do that in the context in which we work is to make really strong arguments based on the data and one's understanding of the economy. That's really all that matters. And that's how it's going to work. And I think that is the way the institution, if that's in the DNA of the institution, that's not going to change.
And then I wanted to ask about a Gallup poll that showed that Americans now have more confidence in the president than the Federal Reserve when it comes to doing what's right for the economy. Why do you think that is? And what's your response? What's your message to the public?
Awesome. I'm glad.
Our response is we're going to do everything we can to use our tools to achieve the goals that Congress has given us.
We'll call it a quick
And we're not
there
going to
on
get
the
distracted
actual Fed
by
conference.
anything.
Thank
So
Hal,
I think that's what we're going to do. We're just going to keep doing our jobs.
entertaining as always. I'm going to stop that, but before we go, I am going to have a little bit of a recap.
Claire Jones, Financial Times. Given the rate,
so we'll get out of that here. You guys can see the charts now. Hopefully, that's come up okay. Let's get over here and have a little look at what's been happening then. So ultimately, it was a pretty good event. To be honest, I was as happy as I suppose not quite as I could have been. There were a couple of things that I didn't get the answers I wanted on. But what we do know without a shadow of a doubt is that there is going to be a much longer and dragged out a cooling monetary policy cycle than we initially considered. Next year does not look like we are going to get back to that target. 2027, we're not going to get back to that target. And now we're looking at 2028. to get back to that inflationary target. This means that rates are going to remain higher for longer. It doesn't seem to be dampening the spirits of the stocks at the moment. I mean, it's clear, right? I mean, we just took the win in the NAS 100 on the long, so it doesn't seem to be dampening the spirits of the stocks. Yeah, from what we've seen there. But we do have a good idea of the Fed's route forwards, a better idea than we had before the session started. And the markets will follow the rates or have an inverse correlation to them. So I say that, to be honest with you, the stocks haven't exactly played ball, have they, with that inverse correlation? They've just rallied, but there were some key takeaways. What I'll do in the morning is I'll put a key takeaways thing together as well, so you guys can all have it in a sort of bullet point format as well. But in terms of the trading activity for the evening, it was pretty decent, gotta say. Really happy with the performance. We were at 2%. We were at 0.2% risk per position. We did one win in the Dow Jones. We did a second win in the Dow Jones, a third which was a loss in the NAS 100, and then had the second attempt, which was an absolute blinding win for a 1 to 2.8. So we have ended up the evening over 1% net return from the event itself, which was great. And I think we made some pretty good calls. I mean, all of these calls were made as a result in real time of what Jerome Powell was saying and how I believe the markets would digest the data, obviously following the rules and processes we have in place with the technical analysis as well. So it's really finding that sweet spot, which I think tonight we had that. So yeah, I guess that's about it, really. I don't have anything more to say right now. I've made a couple of notes on a scrap piece of paper here over the course of the meeting. I'll compile a little list of some key takeaways from the press conference and Powell's thoughts moving forward. Some interesting questions about when he's going to hand in his resignation, wasn't there, from that one reporter? And the other one that was asking questions about political influence and stuff like that as well. There's certainly a lot going on behind the scenes that we're not privy to. And I mean, to be fair, I mean, Trump's a pretty vocal guy, isn't he? And he's been quite vocal about one minute he wants to fire Powell, the next minute he doesn't want to fire Powell. And even though he actually can't, I mean, he's been doing things that he shouldn't have been able to do the whole time, but I'm not sure what the process would even be with that. So it's an interesting one. And yeah, I wonder who we'll get next. Look, for all Jerome Powell's sins, he is actually one of my favorite central bankers out of them all. He just seems to have his head screwed very tightly on his head. And yeah, I think it would be a shame to see him go, to be fair, as far as they're concerned. But I guess, we don't know who's up next. So we'll have to take that when we get to it. Anyway, I'm waffling now, guys. Definitely different than usual. Oh yeah. So that's about it, team. I will wrap things up there and wish you all a wonderful evening. So I hope you enjoyed the session. I know it's a bit of an awkward time for you guys. It's a bit, it was an awkward time for me as well, but I do hope you enjoyed the session. It's, some of these are really good. A lot of them can be a waste of time, but this one I think was worth it. And I don't feel like coming on tonight has been a wasted opportunity by any stretch. So have a lovely evening, team. Been a pleasure as always. Look forward to catching up tomorrow where we hammer away at the markets again. And yeah, look forward to catching you then. So take care, guys, and I'll catch you later on. Thanks a lot. Bye-bye.